All right, class, I want you to go ahead and open up chapter 3 PowerPoint slides. And I want to talk about working on these. Now, chapter 3 PowerPoint slides, we start talking about what we call the adjusting process. The adjusting process is something that when I was in college, I learned just like you guys are going to, except I learned a lot more in depth. And it was something that I had forgotten throughout my college years until I got out into the real world. As soon as I got out into the real world, it became something that was expected to be known. The problem, and I'll repeat this again, the problem with the accounting here is that most of you guys are not accounting majors. Most of you guys are taking this course because it's a prerequisite. So I am going to try to fly through this and I'm going to try to make it as easy as possible. One thing I will tell you is that the test question when it comes to adjusting entries is, I believe, 5 or 6 questions, five or six journal entries. And what I will do is we'll use the same exact question that we use for practice on the exam. The only thing that will change would be the account names and the amounts, meaning I'm going to change numbers and account names. The principle behind them are going to stay the same. So it should be very easy for you guys to go ahead and relate the information to what we need to relate it to. So with no further ado, I want you to open up those chapter 3 PowerPoint slides and we're going to start talking about them quickly. Please make sure that you have a pen and piece of paper there. I would like you to take some notes so that when we do get into the actual question portion, you'll be able to follow along and have those notes to look at quickly. All right. So now that you got them open, slide number 2, it talks about the adjusting process. It always happens at the end of an accounting period. And what happens is sometimes there are things that are unrecorded for the year, meaning there's no paper trail for them. Okay. It may be you just got a bill in for taxes. The biggest one that we're going to be using is going to be the one where we have things that have been used up during the year. And there's going to be some key terms or words that I'm going to have you guys look for when it comes to doing these problems, because certain words will kind of give you an idea of which of the adjusting entries you need to prepare. There are 4 adjusting entries that we're going to be talking about. I'm going to break them down. The way that I'm going to break them down to you is I'm going to tell you what type of an account you're going to use and what's going to happen to that account. So if I say that you're going to be increasing an expense account and decreasing an asset account, so you're going to be debiting whatever expense account we're talking about, and you're going to be crediting whatever asset account we're going to be talking about. So it's going to be up to you to come up with the account names. I'm going to give you their overall classification. If it's something like, if we're talking about real estate taxes and you haven't paid them yet, that means chances are you're going to have real estate taxes payable, which would be a liability. So I'm going to give you the overall generalization. You guys are just going to have to come up with the account. It's going to be in the question itself. So it's not like you're going to have to kind of, perform brain surgery or rocket science to figure out what the account we're talking about. The accounts are going to be listed in the question itself, so it should be pretty self-explanatory when we get to them. So mainly the adjusting process is when things are not recorded daily. It happens typically at the end of the year. So that's pretty much all slide 2 is talking about. Slide 3, the biggest thing on slide 3 that I want you to know is the very last thing. And the very last thing on slide 3 says, whenever you're doing an adjusting entry, you will never, ever, 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 and ever, never use the account cash. Okay, if you start to write the word account cash in any journal entry for an adjusting entry, you're doing something wrong. Okay, cash is never used when it comes to an adjusting entry. So that's the main thing I wanted you to get out of slide number 3. And what we're going to do now is we're going to start right into the 4 different types of journal entries that we're going to be talking about, or I should say adjusting entries. The first one is listed on slide 4, And I know how college students are. When you see a slide with a bunch of writing on it, you guys cannot and hate it. And it becomes like World War II to do it. So what I'm going to talk about is type number one is going to be pretty much when we're talking about prepaid expenses. So what I want you to write down on your little note piece of paper that you should have with you in a pen is I want you to write down the following type of entry. You're going to write down type one, and you're going to write down expense account, debit, asset account, credit. So what's going to happen in a type 1 journal entry, adjusting journal entry, is that you are going to be debiting an expense account, whatever type of expense we're going to be talking about. That's going to be debited, and the credit is going to be the asset account. Okay? That's going to be what a type 1 journal entry is. And pretty much they talk about prepaid expenses. So you can use your imagination. Prepaid rent, prepaid insurance, supplies would be one of the types of accounts that we're going to be looking at for a type 1. So just to give you an idea, those are some of the things that we're going to be looking at. Okay. Slide 5 talks about type 2 adjusting entry. Excuse me. And a type 2 adjusting entry, you're going to have the following situation. So you're going to write down type 2, and you are going to be debiting, again, an expense account. And this time, instead of crediting an asset account, you're going to be crediting a liability account. Okay? So this is for unrecorded expenses. Which you haven't received a bill for, but you know you're getting a bill and that you haven't paid for yet. Okay? So it's one of those things where this could be a credit card bill, for instance. You know you have a credit card bill coming in at the end of the month, but you just haven't got the bill yet. You obviously haven't paid the bill yet. So you're going to debit an expense account and you are going to credit a liability account. Okay. Type 3 adjusting entry is the unearned revenue entries. Okay. So when you see something about revenues that have been paid for but have not been earned, that's an unearned revenue. So here's what we're going to be talking about here. We're going to be debiting a liability account, which means the amount of something that we owe somebody is going to be going down. So on our type 3 adjusting entry, it's going to be liability account debit. And then you are going to credit a revenue account. Okay? So you've got a liability debit and a revenue account credit. Typically, you're going to be talking about unearned revenues there. Now, if you move to slide number 7, slide number 7 is going to be our type 4 adjusting entry. Okay, and what we're going to do on a type 4, the type 4 adjusting entry is you're going to be debiting an asset account. So asset is going to be debited, and then you are going to credit a revenue account. Now, you've already done one of these, unbeknownst to you. This is when you have earned revenues. You've earned revenues already, but you just haven't billed for them and you haven't received them yet. So in other words, you did work for somebody, but you haven't been able to give them a chance to bill them, and they haven't been able to pay you yet. Okay, so it's kind of something that we've looked at when we have had unearned revenue before. So a type 4 adjusting entry is going to be an asset account debit and a revenue account credit. Now, with that being said, I want you to take a look at slide number 8. Slide number 8 is your template for the entries. Okay, and it gives you the different scenarios and things like that you're going to see. So if you take a look at slide numbers slide number 8, numbers 1 and number 2, those two are what we call our type 1 adjusting entries. And some of the keys that you want to look for when we're talking about a type 1 adjusting entry is how much has been used or how much has been expired. Okay, so you can see there on number 1 and number 2, the questions that are listed to the right are some questions to ask yourself when you're doing this type of question to find out what type of journal entry you're going to be working with. Okay, how much has been used and how much has been expired. Number 3, you could see that you're debiting unearned revenue. Unearned revenue is a liability account. And then the credit to number 3 says whatever the company calls its revenue account. So if you look back and say to yourself, well, which entry had unearned revenue as a debit, unearned revenue being a liability, and then had a revenue as a credit? And if you take a look at what you wrote down, you can see that type 3 adjusting entry was a debit to liabilities and a credit to a revenue account. Okay, so number 3 on slide number 8 is a type 3. Take a look at number 4. When we debited an expense account and we credited a payable, I believe if you look back, that should have been a type 2 adjusting entry. And type 2 was expense account debit and a liability credit. Now, the one thing I want you to pay attention to on number 4 here, so the actual number 4 journal entry on this slide is actually a type 2. You can see that it says blank expense and blank payable. You're just going to fill in that blank with whatever account is being spoken about in the question. And some of the examples that could be spoken about, you can see on the right-hand side there. It could be salaries or wages expense. It could be taxes expense and taxes payable. It could be utilities expense, utilities payable. Whatever it is, it's going to be in the question that you're working on. So you are going to be able to figure it out pretty easily without having a bunch to do when it comes to that. Okay, if you take a look at number 5, it says blank receivable or blank revenue. All right, well, I believe a type 4 journal entry, if I'm not mistaken off the top of my head, had an asset account going up and a revenue account going up with a credit. So asset debit, revenue credit. Well, receivable tells you right away that that is a asset. Anything receivable, whether it's interest receivable, accounts receivable, anything like that, that's telling you, the word receivable is telling you that that's an asset. And the word revenue, obviously, is a revenue account. So number 5 is going to be a type 4 journal entry. The last one that I want you guys to know that you're going to learn soon enough is number 6. Number 6 is what we call our depreciation entry. And you're going to debit depreciation expense and you're going to credit what we call an account called accumulated depreciation. Now, there's an easy way to memorize the depreciation expense entry. And that's if I turned around and called you guys a bunch of dead asses. DEAD, dead, dash, AS. Now that stands for, the first 2 letters in the word dead is D and E. Well, take a look at the debit on number 6 for our depreciation entry. The first word is depreciation, the second word is expense. So that's the DE of the word dead. Now, the next 2 letters is AD to finish spelling the word dead. And that goes along with the credit to accumulated depreciation. And the dash AS is simply what it means by the asset name. So depending on what we are depreciating, if we're depreciating the computer, you would write accumulated depreciation dash computer or dash equipment. Now, you're saying to yourself, what is depreciation? Well, depreciation is the loss of value over time. Okay. And what I mean by that is when you go and buy a new cell phone, you have the brand new iPhone 12. Okay. In 4 years from now, is that phone working as good as it did the day you got it? Probably not. So it has lost its value. It's not worth what you paid for it. That loss in value is what we call depreciation. The biggest depreciation that you guys may hear of is if you ever go out and buy a new car. As soon as you drive a new car off the lot, you lose value in that vehicle. You lose about maybe 10 to 15% of the value of that vehicle. Even though you just drove it down the road 1 mile and brought it back, you lose value in that vehicle. Okay? So depreciation is the loss of value over time of assets. Okay? Now, the nice thing about depreciation is that it is deductible. Okay? It is a legitimate business expense. And it allows companies to lower their profits, so to speak, as the value of their assets goes down. Okay, we're going to learn more about depreciation later on, but just for your sake right now, that's what I want you to know. So with that being said, I want to go to a couple things I want you guys to look at. Take a look at slide number 11. Now, slide number 11 is an example of an adjusting entry that you guys are going to be working on. And some of them are going to be pretty easy. Some of them, the biggest thing that you need to do is you need to pay attention to the wording of the question. Okay. If you're one of the people that like to skim read over stuff and just pull out numbers and start multiplying and dividing and subtracting and getting a number and writing it down, it's typically not going to work in this scenario. So I really need you guys to pay attention to detail. Unfortunately, accounting is all about detail. So for those of you that are not detail oriented, I'm going to need you to start trying to be. So the first thing this one talks about is this company's supplies account had a balance of $900. Okay. At the end of the year, December 31st, they counted all their supplies up that they had left in their cabinet. And at the end of the year, they only had $240 worth of supplies left. Now, a type 1 journal entry, one of the questions you want to ask yourself is how much has been used or how much has been expired. Well, if you started with $900 worth of supplies at the beginning of the year, and at the end of the year, you only had $240 left, that means you used up a certain amount of supplies. So to get the amount that you used up, you just subtract in this case. So as you can see from the journal, from the slide here, slide number 11, $900 minus 240, we used up $660 worth of supplies. Now, the journal entry that you would use to go ahead and prepare for this would be type 1. And type 1 talks about debiting a expense count and crediting an asset account. So if you look at slide 12, you're going to see that on December 31st, we debited supplies expense for $660. And then we credited supplies, which is an asset account, for $660. And just a note there, you can see that we wrote down supplies used. That's as hard as an adjusting entry gets for type 1. The hardest part is making sure you understand what the numbers are. Okay, we are only writing off the amount that we have used. We're not writing off how much is left, how much is at the beginning. We're writing off how much we used. Hence the reason why the questions that were asked is how much has been used or how much has been expired. Okay, take a look at slide number 13. Slide 13 talks about insurance having a $300 balance. And that account represents payments for 3 months, December through February, December, January, and February. So if that represents $300 and it represents 3 months, each month costs you how much in insurance? Well, $300 divided by 3 months shows that each month you have to pay $100 of insurance. At the end of the year, at December 31st, how much has been used up? Well, we've only used up 1 month, which is December. So the amount that has been used or expired to answer the question would be 100. So now what you need to do is you need to do your adjusting entry for that, which in this case would be on slide number 14, which you can see says insurance expense 100. And then we are decreasing the prepaid insurance count by crediting it for 100. And that's just showing the amount of insurance that we used or that that has expired. What I'm going to do is I'm going to cut this video short right now because I'm at 20 minutes, which will take forever to upload. But I want you to follow through on taking a look at slides 15, 16, 17, 18, 19, and 20, 21, 22. And I want you to go all the way up to slide number 24. So I'm going to cut the video off here at whatever slide we're on, which is slide number 14. But I want you to continue reading down your slides 15 through 24. Now, one thing I want you to do is, if you haven't done this already, I want you to set it up as a slideshow. It's PowerPoint for a reason. And what I want you to do is from slide 14 down to 24, I want you to set it up as a slideshow. So just go ahead and go up to the top and start the slideshow for you. So that this way, it's only going to give you certain pieces of information as you click. So that this way it actually gets your mind thinking about it. I don't want you to just click on slide 15 and be like, oh, okay, the journal entry's here, it's done. I want you to start the slideshow at slide 14, because once you start the slideshow at 14, you're going to see that your entries are going to come up for you. And I want you to just kind of think about what's happening in each one of those situations. Okay? As I'm going through here and hitting the button, I can see I already have, there's one issue here from after 7 years. I just noticed it. But it's not a big issue. It's just a number wrong. So I want you to just go ahead and go through slide number 24. What I'm going to do is I'm going to get this video uploaded, and later today I will post our first assignment when it comes to this. But please, 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 again, pay close attention and go ahead and continue down to slide 24 using that method. Okay.